When most people think about investing for retirement, their minds go straight to 401ks, IRAs, and Roth accounts. Those are the traditional vehicles for building wealth. And for good reason. They offer tax-deferred or tax-free growth and sometimes even employer matches. But there's another account type that doesn't get nearly enough credit, the taxable brokerage account. It's often viewed as non-retirement money, something to use after you've maxed out the tax advantage options. Yet for many retirees and high earners, it can be one of the most powerful tools in long-term tax and income planning. In today's video, we'll explore why a taxable brokerage account might be better than you think, covering the step up in basis, tax-efficient investing, loss and gain harvesting, and the liquidity and flexibility benefits that most retirees' accounts can't match. Then we're going to go through a case study where we can turn your taxable brokerage account into what I call the Pseudo-Roth account, an account where you can realize capital gains and pay absolutely nothing in the way of federal income tax. It is one of the most powerful tools you have available to you in retirement and can help you stretch your hard-earned dollars even further. But before we dive into all that, my name is Ryan Knoll. I'm a certified financial planner and founder of NAV Wealth Partners, a financial planning firm that helps clients nationwide make smart money decisions. Let's get started. Tax-deferred accounts like 401ks and IRAs get all the attention because the benefits are immediate. You either get a tax deduction up front or tax-free growth later on. A taxable brokerage account, on the other hand, doesn't give you upfront tax breaks. You invest after-tax dollars, pay taxes on dividends and capital gains, and manage the rest on your own. But here's the reality. When they're used intentionally, a taxable account can be just as, and in some cases even more powerful than a retirement account. Why? Because it offers control, liquidity, and tax flexibility in ways other accounts can't. Let's start by talking about liquidity and flexibility. Unlike retirement accounts, there are no contribution limits, no income restrictions, and no early withdrawal penalties with a taxable brokerage account. You can contribute however much you want, whenever you want to, withdraw at any time for any reason. There's no age requirement and there's no 10% penalty. You can use it for big goals before retirement, like a house purchase, college tuition for your kids, or a business investment. And then you can refill it as life changes later on. In retirement, that flexibility becomes incredibly valuable. You can draw from your taxable account during high income years to avoid pushing yourself into higher tax brackets, or use it to fund expenses early in retirement while letting your Roth or IRA accounts grow untouched. The ability to control when and how much income shows up on your tax return each year is the biggest advantage taxable accounts offer. Now we're going to talk a little bit about taxability, and not all investment income is taxed equally, and taxable brokerage accounts give you access to long-term capital gains rates, which are often much more advantageous than ordinary income tax rates. For 2025, the long-term capital gains rates are 0% for taxable income up to $96,700 for people who are married filing jointly, 15% for up to about $600,000, and 20% for anything above that. The numbers are slightly different for single tax filers. The 0% band is half as large, and the 15% bracket goes to a little bit more than $530,000 this year. That means that a retiree living primarily off of Social Security and capital gains could pay zero federal tax on much of their income. Compare that to traditional IRA withdrawals, which are taxed as ordinary income, often pushing retirees to the 22%, 24%, or higher tax brackets. By keeping your investments long-term and structuring the withdrawal strategically, a taxable account can be one of the most tax-efficient income sources you have in retirement. Taxable brokerage accounts are really advantageous from an estate perspective as well through a step-up in cost basis. When you pass away, assets in a taxable brokerage account receive a step-up in basis to their fair market value on the date of your death. That means that all of the capital gains that you had on that position or on those positions are wiped away for tax purposes, and your heirs will inherit the assets with a completely clean slate and can sell them immediately with no capital gains tax implications. Let's go through an example. Let's say you bought a stock for $100,000 that's now worth $300,000. If you sold it during your lifetime or gave it to a loved one as a gift while you were alive, you'd owe capital gains on the $200,000 worth of growth when it was sold, or your heirs would from who you gifted that money to. But if you hold that until your death, your heirs inherit it with a $300,000 basis. There's zero capital gains tax owed in that scenario. So if you were in the 15% tax bracket, that's $30,000 worth of tax savings. By contrast, IRAs and 401ks don't receive a step up in basis. Your beneficiaries pay ordinary income tax on every dollar they withdraw if it's in a traditional account. In fact, they are forced to take withdrawals on an accelerated schedule, potentially causing even more tax than you would have paid. For retirees focused on legacy planning, that step up makes the taxable account one of the most perfect tax-friendly vehicles for passing wealth to the next generation. Now we're going to talk a little bit about how you make the investments inside of your taxable account more tax efficient. And you can manage your taxable account for long-term tax efficiency using tax-smart investments and strategies, the first of which is to favor tax-efficient funds. So index funds and ETFs tend to have low turnover, meaning fewer taxable distributions. Active funds, on the other hand, often realize gains more frequently, generating annual tax drag even if you're not buying and selling during the course of the year. Next is you want to focus on qualified dividends. Qualified dividends, typically from U.S. companies held long enough, 181 days or more, are taxed at long-term capital gains rates of 0, 15, or 20% instead of higher ordinary income tax rates. Next is we want to make sure we're practicing solid asset location, which is placing the right assets in the right accounts. Keep tax inefficient investments like bonds and REITs in IRAs or 401ks, and keep tax efficient assets like stocks, index funds, ETFs, and possibly municipal bonds for your fixed income sleeve in taxable accounts. That way your taxable account generates mostly low tax income, while your retirement accounts defer or eliminate taxes entirely. Finally, we want to make sure that we're harvesting losses and gains strategically. Use market volatility to your advantage. When markets dip, sell investments with losses to offset gains, or $3,000 of ordinary income each year. That's called tax loss harvesting. When markets rise, sell appreciated assets during low income windows to realize gains at 0% tax. That's the strategy we're going to follow when we go over the example of how to make this a pseudo-Roth account. A taxable account gives you that flexibility, something IRAs and 401ks simply can't match. You can even set up a super tax efficient brokerage account by utilizing direct indexing along with tax loss harvesting. This will allow you to follow an index like the S&P 500 or the Russell 2000 by buying individual slices of each stock in the index. As losses occur, they're automatically harvested. You can then do a few things with those losses. Hold them and use them to offset $3,000 worth of income every year and carry forward any remainder. Or you can use it to offset gains elsewhere in the portfolio with no tax implications. This would typically be a good idea to help eliminate taxes on a concentrated position. The main idea, though, is to make a more tax-efficient portfolio than just by buying an index or an ETF and following that index and just being subject to the gains and losses as they occur. It gives you a little bit more flexibility inside of the index itself. One of the smartest uses for the taxable brokerage is income coordination with your other retirement accounts. Think of your taxable, tax-deferred, and Roth accounts as 3 distinct buckets. Each one plays a role depending on your income and tax bracket in a given year. In higher income years, draw from your Roth to keep your AGI low, but ideally leave Roth alone as long as possible because it's the most tax advantageous. In low income years, draw from taxable accounts or do Roth conversions, and use your taxable account to cover spending while converting pre-tax IRA money into Roth at more favorable rates. This strategy smooths out your lifetime tax bill and prevents spikes later on when RMDs begin. It's one of the biggest reasons I tell retirees the taxable account isn't just a leftover, it's the control valve for your entire retirement income plan. Something else that's a positive when it comes to your taxable brokerage account is accessibility during early retirement. If you retire before the age of 59 and a half, accessing money from IRAs and 401ks can come with a 10% penalty unless you use special exceptions. A taxable account, however, is penalty-free. That makes it an ideal tool for early retirees or those easing into retirement before Social Security or pensions begin. For example, if you retire at 58 and plan to delay Social Security until 70, your taxable brokerage account can bridge that 12-year gap without triggering early withdrawal penalties or heavy taxes. It gives you true financial independence, the ability to retire when you want, not when your retirement incomes say you can. A taxable account can also help you rebalance your portfolio across all your different account types efficiently. Instead of selling in your IRAs, which triggers taxable withdrawals, or your Roth, which you want to preserve, you can use your taxable account's cash flow, dividends, interest, or selective sales to rebalance your overall allocation more efficiently. That allows you to stay invested and tax efficient without pulling income unnecessarily. But even with all that said, the real power of a taxable brokerage account shows up when it's part of an integrated plan. And here's how your pieces will fit together. You have your tax deferred accounts like your traditional IRA and 401k, which provide immediate tax deductions and grow tax deferred. You have your tax-free accounts, which have anything with the word Roth in front of it, and they provide tax-free withdrawals and no required minimum distributions at age 73 or 75. And then you have your taxable accounts, which provide flexibility, step up in basis, 0% capital gains potential, and liquidity. In retirement, the ideal approach is to blend these three buckets each year, drawing from the taxable account for spending flexibility, the Roth for tax-free growth, and the IRA strategically to manage your brackets. This combination can dramatically lower your lifetime effective tax rate and extend the longevity of your portfolio. Before we jump into the reason you're all here, which is how to turn your taxable brokerage account into your Pseudo-Roth account, I wanted to take a minute to thank you for watching our content. We've really taken off on the channel over the last few weeks, and the NavWealth team really appreciates your support. Meeting you in the comments section and over Zoom to talk about your own unique situation means the world to us. We're also happy to be a resource for you, and for some of you, even being your financial planner, helping you navigate your retirement. And if you're new to the videos, please throw us a like and subscribe to continue to follow along. We plan to continue posting valuable content weekly and helping guide you on your retirement journey. Let's jump back into the video and find out how to turn your taxable account into your Pseudo-Roth account. Okay, so now it's time for my favorite way to use your brokerage account, and that's building it into a Pseudo-Roth account. The idea is relatively simple, and it's based on what your taxable income is. And if you're married filing jointly, you want to keep your taxable income below $96,700. And if you're single, it's exactly half of that amount. And taxable income is just your adjusted gross income less the larger of your standard or itemized deduction. So let's start with an example. Let's assume we have a couple, they're both 65, and they're retiring today with $500,000 in their brokerage account, $700,000 in traditional accounts, and $300,000 in Roth accounts. The cost basis of their brokerage account is $200,000, meaning they have $300,000 worth of gains. They're also expecting Social Security of $60,000 between the two of them if they were to claim today. And they have no other sources of income outside of their assets that they've accumulated. They have annual expenses of $75,000. And finally, we are going to assume they only take their standard deduction every year just to simplify the example. What's most important for them is how they're going to convert their traditional IRA to Roth. So we're going to first look at that process. In order to maximize their Roth conversions, I would recommend delaying their Social Security. They will first use their traditional IRA for two reasons. First, to meet their living expenses, and then maximizing Roth conversions. And ideally, all Roth conversions would be completed no later than when they start claiming their Social Security benefit. So let's assume their optimal withdrawal from the traditional IRA is $175,000 every year. It may be slightly different, but we're just using that to simplify the example, and we're going to assume that's optimal moving forward. Again, we would do a little more work in the background to verify this, though. So their taxable income is going to be approximately $131,000 when you factor in their standard deduction and the enhanced senior deduction they're eligible for the next 3 years. They will owe approximately $19,000 in taxes on that $131,000 worth of taxable income. They will pay those taxes from the brokerage account. They will take $75,000 from the IRA withdrawal to live on, and the other $100,000 from the IRA withdrawal will go directly to the Roth account. By the time they reach age 70, they will have completely liquidated the traditional accounts and have moved it all to Roth or used it to live on. And their assets would look something like this, assuming everything earned an equal 8% rate of return. They'd have about $1.2 million in Roth, $640,000 in brokerage, and nothing in traditional. And their Social Security benefit would have grown to about $84,000 annually when they go to collect at age 70. Now, by the time they're age 70 and ready to take their Social Security, we have my favorite Pseudo-Roth account all set up. And here's how it's going to work. First, we need to figure out what their taxable income is before they take any capital gains. Their only source of income is Social Security, which is 85% taxable to them. That means roughly $71,000 of their $84,000 of combined benefits is added to top-line income. And what we want to do now is take our standard deduction from that. They will no longer be eligible for the enhanced senior deduction because the tax code would have phased it out by then. But let's assume that their standard deduction is still around $32,000 at this point. Their total taxable income at this point is $39,000, which means they have roughly $58,000 worth of gains they can realize before they hit that $96,700 level of making their capital gains taxable at the 15% level. And that's completely tax-free now within that 0% tax bracket. So let's assume they realize up to that limit. Assuming a pro rata capital gain to principal withdrawal on the $58,000, that frees up roughly $93,000 worth of cash. And I get this number because roughly 62.5% of their taxable brokerage account is capital gains. So we divide the $58,000 by the 62.5%, and that gives us $93,000 worth of cash to use at our disposal now for the year. So at this point, they have $177,000 worth of cash. $84,000 from Social Security, and $93,000 from selling in the taxable brokerage account. They will only owe $4,000 in federal income tax, and that's all from their Social Security benefit. They need $75,000 to live on. So adding up those two uses of cash, which is the taxes that they owe and the money they're going to live on, is $79,000. That leaves them with roughly $98,000 to now reinvest back into the brokerage account at a higher cost basis to maintain better tax efficiency over the long term. And that's the Pseudo-Roth account in action. We recognized $58,000 worth of capital gains, we paid no capital gains taxes, and we're building an even more tax-efficient portfolio along the way for future distributions by maintaining a higher cost basis on that reinvested money. And this is how you build the most tax-efficient retirement plan there is. The taxable brokerage account doesn't get that marketing that retirement accounts do, but for retirees and high earners, it's often the most versatile and underappreciated account that you have. With liquidity and no withdrawal rules, favorable long-term tax rates, step-up in basis for heirs, strategic loss and gain harvesting, and integration with your Roth and IRA strategies, it can act as both your financial cushion and your tax optimizer. So don't think of your taxable account as leftover savings. Think of it as your flexibility fund. It's what lets you control your taxes, manage your cash flows, and adapt your retirement plan as life changes. And when structured appropriately, it can have the same impact as a Roth from a tax perspective when you withdraw from it. Absolutely nothing. That is the beauty of the Pseudo-Roth. If you want help building a coordinated plan that uses all three account types to minimize taxes and maximize flexibility, that's exactly what my team does at NavWealth Partners. We'll help you turn your taxable account into one of the smartest parts of your retirement strategy. Thank you so much for watching, and as always, make smart money decisions.